Welcome to FYI, the For-Your Innovation podcast. This show offers an intellectual discussion on technologically enabled disruption, because investing in innovation starts with understanding it. To learn more, visit arc-invest.com.
ARK Invest is a registered investment advisor focused on investing in disruptive innovation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. It does not constitute, either explicitly or implicitly, any provision of services or products by ARK. All statements made regarding companies or securities are strictly beliefs and points of view held by ARK or podcast guests and are not endorsements or recommendations by ARK to buy, sell, or hold any security. Clients of ARK Investment Management may maintain positions in the securities discussed in this podcast.
Welcome, everyone, to ARK's podcast, FYI. Today, I'm joined by Steve Vannelli. He is the founder, CEO, CIO of Knowledge Leaders Capital. My name is Vannelli. I'm ARK's client portfolio manager, and we have a lot to cover today. Thank you for joining, Steve.
Thank you. Thank you for having me.
So maybe we'll just start off with a little background. So as client portfolio manager, I've been with ARK for a little over 4 years. I've been working alongside Kathy Wood. The number one question I'm getting from clients is, has innovation hit the bottom? When are we going to see a turnaround in performance? I mean, it's been a bear market for 18 plus months with growth underperforming value. Seems like you're starting to see some signals like us that we may have hit the bottom and that we could start to see a turning point. But before we kind of dive into that, would love to hear a little bit about your background, kind of why you started the firm and what you all offer.
Sure. We're based in Denver, Colorado, and our unique intellectual property is dealing with intangible assets. And we've developed a proprietary method of incorporating intangible investments that corporations make into their financial statements. And we've developed a proprietary process where we, in effect, capitalize research and development expenditures, treat them the same way that a company would treat CapEx, run it through the statement of cash flows, put an asset on the balance sheet, flow a non-cash charge, an amortization charge through the income statement reflective of that consumption of fixed capital, and then evaluate company fundamentals and valuations on the basis of giving companies credit for their innovation activities. So we're not trying to, let's say, put a value on the brand of Coke. What we're trying to do is capture the investments, the capital accumulation that companies are endeavoring. And for us, really, whether a company spends money externally, buys CapEx from somebody else, or spends money internally, runs a research lab, there's really no difference. I mean, it's both investment. If you're foregoing current consumption for future benefits, that's an investment. And so the crux of what we do really began in 2003 when the Bureau of Economic Analysis and the National Science Foundation started a collaboration creating a satellite account, the GDP account, ostensibly designed to capture research and development. Prior to that, it was an intermediate expense. And so they wanted to put it into the C plus I plus G plus net X framework that is GDP. And so in doing so, they had to come up with a lot of variables, the useful life of intellectual property, different forms of intellectual property, kind of an amortization schedule, residual value, and they did all that kind of stuff. And then they blended it into the national income and product accounts in 2014, I believe. And since then, several other countries have done the same thing. And so what we really did was take the work that came out of that project, that collaboration with the BEA and the NSF, and bring it down to a company level. Our purpose isn't necessarily trying to get national income and product accounts more correct than they may be right now. Our purpose is trying to capture corporate fundamentals more correctly than they are right now. And there was a great piece put out a week or two ago by the well-known Michael Mauboussin from Morgan Stanley called Return on Invested Capital. And it's a long piece, lots of math, really good stuff. But one of the issues he takes on is the idea of intangible capital and how that impacts not only the numerator, your flow, but also the denominator, the amount of capital that you have. And unless you make an adjustment to the flow and to the level, you don't come up with a correct number for return on invested capital. And so while he, admitted that it's a lot of work calculating these numbers, and we can attest to the fact that it is a lot of work calculating these numbers, we just did our rebalance, and we have intangible adjusted data on about 10,000 companies around the world, and we've just finished coding it all out in Python to do our processes, and the code to get through all that's about 9,000 lines in Python. So it's a pretty extensive data project to capture all that stuff, but that's our unique special sauce, if you will, of how we look at the world. And so when you touched on factors, we don't really look at innovation, as a factor, quote unquote, like you would, cap size or dividend yield or things like that. It can take many forms. And so what I found interesting lately was that Bloomberg, in their factors to watch function, if anybody's a Bloomberg user, created a new factor in the investment category called R&D as a percent of sales. And so they do like other folks do when they try to isolate factors. They calculate the performance of going long the top quintile of companies contained in the basket and short the bottom quintile of companies in that basket. And so we can look at it for a variety of different benchmarks, and they pretty much kind of say the same thing, whether it's in the United States across cap size or internationally. So I looked at, because I don't know, what indexes everybody may have access to, I kind of crunched the numbers on a few of them, but the Bloomberg 500, which is the 500 large cap companies that Bloomberg captures in their index, that Q spread peaked in February 14th of 2021, and it just troughed in May 11th of 2022. So that's a 15-month long bear market, down 65%. And again, that's the quintile spread, down 65% over 15 months. And so you're up about 5% from the low, but to your earlier point, Ren, that was a 15-month bear market, and that bear market's been in place for a long time. Same idea when we look at the Bloomberg 1000, which just brings in the next 500 companies. That peaked in February 14th of 21. It troughed again May 11th of 22. That was 15 months, and here it was an 85% drop in the quintile spread. So it means that the highest quintile of most R&D as a percent of sales companies underperform significantly the bottom quintile companies that largely do no R&D as a percent of sales, energy companies, let's say, for instance. And so that was a 15-month bear market as well. We can get into some indexes that folks are more used to looking at. The Russell 2000, that peaked on July 8th of 2000. It fell 120%, the quintile spread, into the 526.22 low. 23 months long, 23-month bear market that the Russell 2000 innovation companies experienced. And you're about 6% off the low. Getting into the S&P 500, a little more mainstream, it peaked on July 8th of 2000, fell 30% into 9/15/22, September 15th, 22, which was the low. Interestingly, that was the week before the Fed really launched the last 75 basis point rate hike and guided expectations, significantly higher towards the end of the year and into the terminal rate. Nevertheless, the highest quintile of R&D stocks, those that are, normally thought of the longest duration stocks out there, have not underperformed since that time. That was a 22-month bear market as well. The S&P 600 peaked on April 2nd of 2020. It made a trough on June 13th, the day of the market low back in June. And it's up about 4% from the lows. So that's about a 26-month bear market for the S&P 600. So, pretty good duration bear markets, pretty good duration declines. And then when we look overseas, I did it for the Nikkei 225. Obviously, it's fewer companies in the S&P 500, but its quintile spread peaked on July 30th of 2020. It's fallen 30% into the trough on October the 12th, so a couple weeks ago, October the 12th of 22, and it's up a couple percent from the low. That was a 21% bear market for the most innovative quintile of stocks in Japan. And then lastly, through this lens, we can look at Western Europe, and the Bloomberg Western Europe index peaked October 14th of 2020, has underperformed or fallen by 25% relative to the lowest quintile, made a trough on May 12th of 2022, and is up about 7% from that period of time. So interestingly, what we see is that Western European highly innovative companies have actually had the strongest bounce back, one of the earlier lows, but one of the strongest bounce backs from that low. And I think in part that's probably explained by the composition, where it's a little more healthcare tilted, a little less technology tilted. But nevertheless, that was a 19-month long bear market for Western Europe.
Yeah, you touched on a lot there. So I want to unpack some of that. And going all the way back, you touched on intangible assets. So for the non-accountant listeners we have, could you just define what that means and maybe give a few examples of, for innovative companies, what are those intangible assets? How big? Maybe a few company examples. What are we talking? Like how big are these intangible assets that it feels like people aren't really thinking about? Certainly in this bear market, they're just just mostly indiscriminate selling, risk off assets, and they're not really paying too much attention to these intangible assets that, from ARC's view, when we look across our technology platforms, especially artificial intelligence, all the way through genomics, blockchain, these can be very valuable, especially the underlying data that these companies are accruing, because more data, more, better you can create these neural net algorithms. And so that should be valued somewhere. A lot of these companies aren't even really, valuing it or having it on their balance sheets.
Yeah, those that organically generate it don't. Of course, those that buy it via acquisition end up with an intangible on their balance sheet called goodwill. So there's an even further asymmetry of how innovation is accounted for. If you build it, you get penalized. If you buy it, you get preferential treatment, so to speak. There's several, major genres of intangibles that we think of. One is scientific R&D, two, non-scientific R&D. So the creation of, artistic works, things of that nature. And then there's things that are kind of outside the realm of R&D, brand development, employee training, creation of databases and codified customer information. So it isn't all necessarily like hardcore, ones and zeros, bits and bytes. A lot of it is investments that companies make into their people or make into their processes and make into their manufacturing processes. It's funny, I'm reading the book Chip Wars, which is very timely given what's going on with the Biden administration and new rules put in place with China. And one of the struggles the early semiconductor industry had in the 50s and 60s at Fairchild or Semi or Intel was yields, and yields were very, very low. And so on the order of close to 0%. And so what occurred pretty quickly was it was a precision manufacturing operation, and that a lot of R&D and intellectual property, went into not just designing the semiconductors, but designing the processes and the workflows and the machines that led to higher yields. Because at the end of the day, if your yields are close to zero, you're just making a bunch of trash off the end of your assembly line. And so these things kind of get bundled together. But, when you have developed the capacity to produce a differentiated high-end good or service, you kind of need the ability to execute on doing that. And there's a suite of intangibles that go along with that. Some of them captured in R&D, some of them not necessarily captured in R&D. And that's another difficult challenge for companies that we had to deal with, is that there's other intangible spending that goes on outside of R&D for companies. Again, some of the ones I talked about prior. So, the aggregate amount spent on intangibles is much more than simply that spent on scientific and non-scientific R&D. That might be a conversation for another day, but I thought it would just be good for the listener to understand that, R&D in our work represents about 40% of total intangible spending. So it's significant, but it's not the whole enchilada.
Yes. So what are some of the examples, of that other 60%?
Well, again, they really kind of vary across industry from, brand development to employee training to all sorts of things, improving manufacturing, sustainability initiatives, energy transition initiatives. I mean, there really is no kind of one size fits all, if you will, but I will put a number to it. If you pull up kind of a reported financial statement, reported balance sheet for Intel, you see about 100 billion in assets. When we look at our intangible adjusted financial statements, we see about 140 billion in assets. So what we see is about 40 billion more in assets, which is reflective of there's some history of intellectual property investments carried at depreciated historic cost on their balance sheet. So again, not an exercise in valuing, the brand or the manufacturing prowess, just simply an exercise in measuring the amount of money that they spent, invested in this area over time. And so the way we think about it is that the more IP that you can see in the present, it has a relationship to earnings in the future, right? I mean, the bigger the tree that you see, you kind of say, wow, the bigger pieces of fruit I would expect to come off of that thing. And so, we look at it like that the present value of that R&D, present value of all those intangible assets equals the discounted future cash flows that will be produced by that capital good, right? So, if you're running a restaurant, you're considering buying an oven, you think about, well, the oven is worth the sum of the future discounted meals that I can produce in it. Now, capital goods kind of work the same way. So R&D projects kind of work the same way. So, when we see more assets in the present, it means to us there are more earnings or more hidden earnings out there in the future that are drivers of the company's profitability.
But in today's market, it doesn't seem that, the market doesn't care about those future earnings. They want earnings now, right? Because we're entering potentially, we think we're in a recession. Others think it's right around the corner, early stages. But, the market's wants kind of strong earnings, right? And for those that are promising them at, 2-3 years out, that's not good enough.
Yeah, I think that's a fair point, but I think that's also why, in anticipation of this rate cycle, why innovation has corrected so heavily and for so long. And I think that, I have some numbers that I could throw out there that would suggest to us that you've gotten down to a point now where highly innovative companies on a like-for-like basis compared to their, non-innovative peers are not just relatively cheap, but are in an absolute sense going for pretty cheap multiples, the way we look at it. So, I could start with, say that first quintile of the S&P 500 that we began the conversation with about the quintile spread. So if you divide up if you look at the first quintile of the R&D, you got to take out energy and utility companies. So you're not looking perfectly at 100 companies. It's actually 83 companies. And for a quality check, 11 of these companies have no adjusted net income and 3 have no adjusted cash flow. So, not many, pretty high quality group of companies, but in aggregate on a reported basis, those 83 companies did about $292 billion in R&D. They have an aggregate market cap of about $6.5 trillion and net income on a reported basis of $222 billion and cash flow on a reported basis of $368 billion. Well, when we add back R&D to that as a shorthand to our process, just to clean it up off the income statement, what we get is going from 222 billion in reported net income to 514 billion in adjusted net income, going from 368 billion in reported operating cash flow to 660 in adjusted operating cash flow. And so why that's important is that when we look at aggregate variables, so if we look at the reported side, if I just simply take the 6.5 trillion divided by the net income of 222 billion, I get and these are all trailing 12-month figures, okay? So none of this is forward-looking. These aren't forward estimates. These are trailing 12 months. I get a PE ratio of 29.42 and a price to cash flow ratio of 17.79. When I look at it on my adjusted basis, when I add R&D back to net income and to operating cash flow, I get a PE of 12.74 and a price to cash flow of 9.93. So those are respectively a 56 and a 44% discount to the reported valuation metrics. And so, I think the thing to take away here is, yes, investors seem to have a preference right now for shorter duration stocks, But we've gotten to a point after 2 years of getting so oversold, the innovation space is actually cheaper in many ways than the non-innovation space. If I look at I can take the S&P 500 and divide it into two groups of companies: those that spend money on R&D and those that don't spend any money on R&D. Interestingly, out of the 500 companies in the S&P 500, 161 spend $1 on R&D. 339 companies spend nothing on R&D in the S&P 500. Okay, so those 161 companies in the S&P 500, trailing 12 months, spent $478 billion in R&D. Okay, that's $500 billion that's kind of up for grabs here, a jump ball when you think about which accounting methodology do you want to subscribe to. $500 billion really moves the needle when you start thinking about PEs and valuations for the market. So for the R&D spenders, they had a reported net income in aggregate of $785 trillion and reported cash flow of about $1.1 trillion. When we add back R&D, we have an adjusted net income of $1.264 trillion and an adjusted operating cash flow of $1.55 trillion. So when I aggregate those valuations for the R&D spenders, the aggregate PE is about 23.27 times on a reported basis, but it drops to 14.46 on an adjusted basis. The reported price to cash flow is 16.96 on a reported basis, again, not making the adjustment, drops to 11.75 when we incorporate those intangibles. Interestingly, when we look at the 339 companies that are non-R&D spenders, obviously they do R&D of zero. They're adjusted, since there is no adjustment to make, their adjusted net income is 1.01 trillion. So for the 339 companies that don't spend R&D, their adjusted net income is 1.01 trillion, while the 161 companies that do R&D, their adjusted net income is 1.264 trillion. So the 161 out-earn the other 339 by a couple $100 billion. Cash flow is a little closer. The non-R&D spenders clock in about 1.4 trillion in adjusted cash flow. R&D spenders alone, 1.55 again trillion in operating cash flow. So when we look back over the last 12 months and do valuations, the aggregate PE for the non-spenders, 41 times. Aggregate cash flow for the non-spenders, 29.86 times. And there's no adjustments to make there because they don't do any R&D spending. So when we focus in on 161 out of 500 companies, that's what, 32%? So only a third of the S&P does any R&D at all. And these are the companies where there's roughly 500 billion in debatable expenses, investment, all that kind of stuff up for grabs. And as you can see from the numbers that I just went through, huge impact on valuations when depending on which mental switch you have on, the non-R&D spending mental switch or the R&D intangible investment switch flipped in your head.
And are these R&D spenders, are they concentrated in the obvious kind of sectors like healthcare and maybe technology?
Yeah, they are. For the S&P 500, I'll do the quintiles. So for the first quintile of the S&P 500, it's about 51% tech and about 24% healthcare. But that changes when you get down into some other companies around the world. So when I look at Western Europe, Western Europe's 43% healthcare. So that also helps explain why Western Europe has bottomed and done a little bit better over the last handful of months. Greater concentration in innovative healthcare companies rather than technology necessarily. That quintile in Europe is only about 19% technology. And then in Japan, same idea. About 30% of that first quintile is healthcare. About 35% is technology. So for most of these indexes, 70%, 60, 70% of the index of these top quintile R&D spenders, technology and healthcare.
And is it fair to say, most of these unprofitable companies, right, would be technically profitable if you were to capitalize the R&D like what you're doing, right?
Some would, some wouldn't. When you get down into the small cap, so when I look at the Bloomberg 1000 group of companies, there's about 43 companies there that don't have adjusted net income. 43 out of 1,000. I mean, you're still talking 4% of the index, and only 8 had no adjusted operating cash flow. So a rather de minimis amount. What I found interesting, though, going around the world was that in Western Europe, out of 70 companies, you only had 1 with no adjusted net income or operating cash flow, or negative, I should say, operating adjusted cash flow. And in Japan, 0. So while the numbers may be a little bit smaller on the amount of R&D that, the companies in Western Europe and Japan do, the valuations are also lighter. I mean, the adjusted price to cash flow on that Q1 first quintile of the Nikkei 225 goes for about 8.5 times cash flow right now. And that, price to cash flow on the first quintile of Western Europe is about 6 times adjusted cash flow. So, I mean, even though the US is cheap at, around 10 times adjusted cash flow, just a little under 10, I mean, you're talking, Europe at 6 and Japan at 8. So, there definitely are some outright cheap pockets of not just the US, but global stock markets, I would argue, that are on offer out there.
Yeah, and I think all the companies you're saying that aren't spending R&D, we've been saying about 50% of the S&P 500 is ripe and vulnerable to disruption. And if you're not spending in R&D, and you have these new technologies coming to market and disrupting, entire industries and potential sectors, that's a bit concerning. If I have a few dollars in the 12 or 13 trillion dollars linked to the S&P 500 index, where a lot of wealth is sitting.
It'd be interesting if they created a kind of a SPY A and a SPY B. SPY A being the S&P 500 that does R&D, and SPY B being an S&P 500 index that doesn't do any R&D. I would go out on a limb and say SPY A has outperformed SPY B pretty significantly over the last decade.
When you look at indices, you mentioned the Bloomberg R&D Leaders Index. Any others that you use as kind of a proxy for innovation? I know it's a little more challenging because it's index by definition is backward looking, so you may not be able to capture necessarily kind of the future innovative companies. They may be because of trading liquidity or size factors. But what do you use? Yeah, and how far back does the data go? Because that's also important.
So part of what we do as a firm is create our own proprietary indexes that drive our investment process. So we have a knowledge leaders developed world index. We have a knowledge leaders US mid to large cap index, a knowledge leader developed international only index, and a knowledge leader small cap only index. All of these are available in investment products. I want to stay away from the compliance line there. But they all bottom kind of in the May or June timeframe. The knowledge leaders Europe benchmark relative to the S&P 500 bottomed in early June. The U.S. small cap bottomed in mid-May. The North America knowledge leaders index bottomed in mid-May, and the Asia bottomed in April. So again, we're talking months since these indexes have bottomed. So those are our flavor of indexes that we create, incorporating our proprietary data. The second way I would answer your question is to say that, I guess there's different flavors of innovation. I mean, just like there's different flavors of anything. I mean, there's kind of the higher quality flavor of innovation where there is profits and profitability and all that kind of stuff that we like. And then there, clearly are the more speculative areas of the innovation spectrum. And for this, I would kind of, use two variables to compare. I'd compare the Bloomberg R&D Leaders Index with the Goldman Sachs Unprofitable Tech Index. Now, in all fairness, I don't have access to the Goldman Sachs Unprofitable Tech Index constituents, so I couldn't do some of the earlier work that I did on it before. But what's interesting when you look at the Goldman Sachs Unprofitable Tech Index, it peaked February 11th, 2001, just around 500 index level, and it troughed about a week ago at about 120. So you're down almost 80% over the last couple of years in the Goldman Sachs Unprofitable Tech. In the BR&D, which is the Bloomberg R&D Index, it peaked on December 7th of last year, and it's fallen 39% and made a low again the other day, October 14th. So, the Bloomberg R&D index would probably be representative of more than just technology, I guess, to be fair, but also representative of, for the most part, I think there was only 11 companies in the Bloomberg R&D index out of 134 companies that didn't have adjusted net income. So, there's a few, but it's still pretty high quality. I mean, you're still even only pushing 10% of the index without adjusted fundamentals in what's designed to be a highly innovative, only index. And the Bloomberg R&D index, while the S&P 500 has a free cash flow, of around 5.5%, it's not that far behind the Bloomberg R&D index. It's like 3.7, 3.8%. So, free cash flow, it all comes together, irrespective of, how you either expense or capitalize R&D. It all comes together at free cash flow. So, if these companies were a bunch of low quality companies, no earnings, no cash flow, no nothing, well, that would still show up as no free cash flow. And so the fact that they're free cash flowing, a percent and a half below the aggregate S&P 500 means that you're just dealing with fundamentally a higher quality group of companies. I mean, this isn't, 2000 anymore where, you had lists and lists of not just unprofitable, but like, no sales, no fundamentals whatsoever to look at. And we invented, price to clicks and all sorts of, 2000 era valuation metrics. That's not where technology is today. I mean, yes, there are a few companies that are kind of out there in the stratosphere, but appropriately viewed, this isn't 2000 again. I mean, my goodness, in 2000, I remember the company I was working at then, selling Cisco in the first quarter of 2000 when it was in the 80s, like 120 times earnings. The high quality companies now that you see nowadays just aren't there. I mean, when I look at like an Amazon, right? In our proprietary work, Amazon goes for 9 times adjusted cash flow right now. I mean, that's just not cheap relatively. That's cheap absolutely. So that's really more of what we're seeing here is that appropriately viewed, innovation has gotten down cheap enough where it's not just relatively cheaper to, old economy energy or, whatever. It's absolutely cheap and it's at an absolute attractive valuation level in our opinion.
You touched on 2 things that I want to go back to. In terms of financial stability, quality, right? I mean, it feels like innovative companies have been priced as if they're going out of business next month, right? Can you talk about kind of whether you want to use the Bloomberg R&D leaders or another index versus, say, a broader index like the S&P 500? What does the financial leverage look like? Even gross margin. I mean, what are some of the financial stats that you can compare?
I think there's a few of interest to investors, and I'll take you up on that. I'll use the Bloomberg R&D Leaders Index, and I will compare it to the S&P 500 in general. And here I'm looking out over the last 15 years, and I'm using reported data, not intangible adjusted data, just straight up reported data, which would penalize more heavily those innovative companies since all of R&D comes out in the current period, right? In theory, an income statement should be reflective of the income generated from the previous vintage of capital goods. So if you acquire a capital good in T plus 1 would be your income statement where you utilize those capital goods, right? And so not only do we have an issue with counting an investment as an expense, we have intertemporal issues insofar as that you're measuring the current vintage of capital accumulation against current period profits, which again is just an intertemporal mistake. But anyway, for another day. So the Bloomberg R&D Leaders Index over the last 15 years has grown its earnings at a compound rate 12.0%, while the S&P 500 has grown at about 6.73% compound over the last 15 years. So almost twice as fast, a little bit less than twice as fast. On a cash flow basis, it's grown cash flow at 12.06% over the last 15 years. The S&P 500 has grown it at 6.3%. So again, just a little bit less than twice as much. The Bloomberg R&D Leaders Index has a gross margin of 58%. The S&P 500 in general has a gross margin of 35%. The Bloomberg R&D Leaders Index has a net profit margin of 17%. The S&P 500, it's just a little bit under 12%. When we do kind of a DuPont style analysis breakdown to arrive at ROE, we're really focused on finding companies where ROA is the driver, return on assets is the driver, rather than financial leverage or manipulation. So the Bloomberg R&D Leaders Index has an ROA, return on assets, 10.55%, while the S&P 500 is 3.9%. So you don't really need to lever 10.55 very much to get a really attractive ROE. Speaking of which, the ROE on the R&D leaders, 32.5%, S&P in general, 22%. And then from a balance sheet standpoint, I think this is interesting as well, because innovation tends not to be debt funded. It tends to be equity funded. For the R&D Leaders Index, total debt to equity, 58%. S&P in general, total debt to equity, 115%. So significantly more leveraged. So in that highly innovative, index represented by Bloomberg R&D Index, you get companies growing twice as fast on average with, a third as much, half as much, a third as much leverage, profitability metrics 50% higher and then some, and cheaper valuations. So, really kind of across the board from a fundamental standpoint, really for us, the sun, the moon, and the stars are all kind of lining up in the direction of, focusing our time and attention on that innovative area that, just like it led the market down, I kind of think it's going to lead the market out.
Yep. So last question on that note, a lot of people compare, they overlay the NASDAQ chart of the 2000s, tech and telecom bust, boom and bust with innovation. They've used our strategy, our disruptive innovation strategy as a proxy. I'm sure they've used, some of these other indices, innovation indices. And it looks like it's tracking almost exactly the last 18 months of that drawdown that we experienced back in 2000, and that the recovery took 15 years. Why do you think this is different? Do you think it's going to be much quicker? What's kind of your take of what you're seeing out there, from a quant perspective?
I don't have that picture in my head, unfortunately, of the unprofitable tech index overlaid on the NASDAQ. I do. I mean, I was in the business and obviously do remember, the sell-off from March 12th or 14th, something like that, 2000, where they didn't ring the bell and stocks going down. And then, the multi-part sell-off after 9/11, kind of a low into July. The real emotional low was into October. And then you made the emotional and price low was October. Then you tested it in March of 2003, and that was it. Again, I just think different time, different place in terms of technology companies were less well developed then. They were less profitable then. I mean, you remember the thrust of the 90s tech boom was really kind of like the internet build out, all the debt that companies like, Global Crossing, Adelphia, I mean, names that no longer exist anymore, that all went bankrupt. You remember the investment banker, Jack Grubman, that ran around helping these companies raise all this money. So, I mean, it got kind of, I don't know, feverish, right? And then after long-term capital, fell in the fall of 98, the Fed turned around and started easing again. And then in anticipation of Y2K, in the fourth quarter of 99, if I remember right, tech stocks were up like 40% because the Fed threw so much money in to the system in anticipation of Y2K. So that took valuations up. I mean, it took things like Yahoo from 1 to 150 in the span of 18 months. So I just think there was a lot more new, unproven ideas. I mean, you guys have done so much work on things like, autonomous EVs and stuff like that. I mean, that's not brand new stuff anymore. People have heard of it. They've learned about it, in part because of all the great work that you all have done. And I just think that the tech sector in a lot of places is just not the same tech sector that it was 20 years ago. Margins are structurally higher. The entrenched position, the moats that a lot of these companies have are significantly greater. They're 20 years down the road, 20 years down the road in terms of productivity. So if you say productivity for these companies was compounding a couple, 3%, right? I mean, you've had a doubling of productivity of these companies. And you've also had in 20 years, the doubling in the processing power of the semiconductor, about 12 or 14 doublings in the power of the semiconductor. And the semiconductor really is the general purpose technology of our current age. And so I think that, companies are able to do more now with that greater computing power. And, the semiconductor helps companies try on new ideas or try new recipes, so to speak, right? They can synthesize or simulate the outcome of a given process or a given chemical interaction or chemical compound or, semiconductor architecture or whatever. You can do so much more of that without having to physically go to market, go to shop and see that your product failed or didn't work as promised. And so I just think the technology industry in most places is far different than it was before. On the downside, if I could, balance that a little bit, is I don't know entirely what the ultimate ramifications are of the U.S.'s policy of kind of getting after some crucial technologies for China, going after the high-end chip makers, NVIDIA, Qualcomm, going after the high-end chip equipment companies, Lam, Applied Materials, going after the electronic design automation software companies, Cadence and Synopsys. I mean, they're really trying to kneecap China's access to technology. And from what I understand, you basically had 45 executives at U.S. tech companies that were working in China, servicing their Chinese customers, that all quit last weekend. Like 10 days ago or 9 days ago, they all quit because Biden gave them the choice. You can either maintain your U.S. citizenship and continue doing this, or you can stop doing this. And so, we see the China tech down today, Hong Kong tech down today. Hard to know, how that's related. But just like that book that I alluded to at the beginning, Chip Wars, is really kind of bringing semiconductors and the manufacture of semiconductors, which really are the crux of our modern society, into the fold. There's a great book that came out a handful of years ago called Splinternet, all about how the internet was going to divide kind of along the same lines, more of a Western kind of style internet, and then more of a, censored kind of Asian China style internet. And so, it's very clear that you're seeing kind of a rift in the technologies between these countries. And I suppose it's for good reason. I mean, the Biden administration suggested that it was because of all the commercial, industrial, military overlap that these high-end chips were finding their way into, military technologies that the U.S. didn't want them to find their way into in China. Hard to know. And it's also hard to know, going forward, what that's going to mean for kind of the relationship, the trade relationship. Asia, China produces so much of the technology goods that we use. Now, they're not developed there necessarily, and we just passed the CHIPS Act here, which is going to dole out $50 billion to build semiconductor plants. So, maybe it goes on without a hitch, and it's just China a little bit worse for the wear, China's military a little bit worse for the wear. But probably a conversation for, your next podcast with like a geopolitical strategist that might be able to speak to that. But that would be my one kind of, hanging curveball out there, if I could, that would concern me about some of these technology companies.
Yeah, and we would agree. We cut back on our China exposure pretty significantly, starting with the Jack Ma news back in November of 2020, and then cut it even further going into the COVID pandemic in early going into 2021. So yeah, we have very little China exposure, and I think that's because of kind of the political situation that's going on. And we're not, we're not macro investors, but when there's a geopolitical risk, that can certainly slow, the pace of innovation in China.
Japan may be the beneficiary out of that. Companies like Tokyo Electron, Advantest, and are caught up a little bit in it, but the Lasertec, the Disco, the Rohm, the Omron. Japan still makes 17% of the world's semiconductors. They could be a beneficiary of all this, depending on how the wind blows.
Yep, very interesting. And as you said, maybe a conversation for the next podcast. Well, thank you for all the stats. You heard it here on FYI from Steve Vannelli of Knowledge Leaders Capital, not Kathy Wood of ARC, that innovation is cheap. And you provided a lot of stats to back that up. So appreciate you joining the podcast, Steve. It's been a pleasure.
Thank you. And we're in violent agreement. So it was a pleasure doing this with y'all. Thank you so much for having me.
ARC believes that the information presented is accurate and was obtained from sources that ARC believes to be reliable. However, ARC does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from ARC. Historical results are not indications of future results. Certain of the statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on ARC's current views and assumptions and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.